Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. In this 2-minute trading tip, we'll be discussing some of the best approaches for setting stop losses. First, let's quickly cover the considerations you need to account for in determining your risk management. Before entering a trade, a trader should know the dollar risk that they're assigning to that trade, their stop loss location, the targets that they expect to hit, and the volatility of that product. So there are 2 methods for setting stops that we believe traders should consider. The first is a volatility-based stop. At Convergent, we provide our members with a report containing the rotation sizes on a 1-minute periodicity in a variety of the most popular futures products. For our members, this is updated weekly. However, this image is a year old at the time of this recording, so I do not recommend using these rotation sizes to set your stops in current markets. You can learn more about the harmonic rotations by watching our webinar, How to Trade Futures Like a Professional Day Trader. Traders may use a normal rotation or X% of a normal rotation for their product to determine a stop loss that makes sense given the market's current volatility. Next, we can set a stop loss based on market structure. To simply illustrate this example, let's say a market is trending up, pulls back, and we enter a trade on the breakout of the high for the next leg up. A structure-based stop would be setting our stop loss at the low of the pullback or consolidation area because this is the invalidation point at which our thesis on the market continuing to trend higher is now wrong. The invalidation point for your setups and trading plan will differ based on the types of trades that you make and your overall trading strategy. So what sort of stops should we not be applying? We should not be entering trades with a completely arbitrary stop that was not predetermined before entering the trade. We also shouldn't be setting a stop that's too tight relative to our product's volatility, which can result in being stopped out early on a trade that goes on to work as expected. These stop loss errors often trigger traders to make discipline and psychology-based errors like taking multiple re-entries, FOMOing into trades, or revenge trading. If you don't believe that you can withstand the risk required for a structure-based or rotation-based stop loss in your product, you must size down or elect to skip the trade altogether. Placing incorrect stops will dramatically dull the edge of your strategy. If you'd like to learn more about how traders are ruining the edge of their profitable strategies, be sure to subscribe and join us for our upcoming webinar, Are You Ruining Your Own Edge?, hosted by Futures Trader 71.